Hey, welcome back to Two Super Guys Red Sox. I'm Dylan.
And I'm Vinny. And holy crap, we got some PCE data this week. Jerome Powell, the Federal Reserve's best inflation data point. I'm going to look through a couple of things about why we're still having inflation, at what level, and how I think it's finally going to resolve and what's going to trigger it. Talk about it.
Two Super Guys Trade Stocks.
Yes. So, you actually saw the PCE data came out this week. All right. We've talked a little bit about that before. This is what you're seeing as far as like headlines, basically saying like, all right, inflation is tracking sideways. Consumer spending was a little bit, kind of weaker. That's going to be a major kind of talking point a little bit later on in the video. Mixed signals of the Federal Reserve. They don't really know what the hell they're doing. They're just going to pause here and wait and see what happens until they actually have like a clear and definitive evidence of what's going on before they make any moves. All right. This little snippet here from this NerdWallet, economist, that was interesting. People have been pinched for a while, and it's likely starting to show. The cooling is encouraging for slower inflation in the coming months. All right, so that's kind of where I want to get to as far as what may cause inflation to finally resolve. But we're gonna look at some other things first. All right.
Yeah, because I'm going to wait.
All right. So this is the actual personal consumption expenditures. This is PCE. This is the data that Jerome Powell likes as far as inflation. And we did make some significant progress from the peak here, but we've kind of flattened out for a while now. And that trend is going to be reflected in many other items when you look at a line-by-line kind of analysis of the latest PCE report. Right? So this is the headline number we're looking at, 2.7%. All right, that's trailing 12 months. You can see we've had a few months in a row here. We actually had a slight uptick compared to, this time last year where you're looking at 2.5% as of a couple months ago. That's the 1 year rate of change. But we've had a slight uptick there. Like I said, on the chart, it's more like it's just flattened out. We stopped making progress. This is line by line when you're looking at the actual categories that make up PCE here. So overall, this whole first page is different goods categories. And, goods have come down quite a bit, 0.2% on a month-over-month basis. Now, there were times where it was significantly better. If you look, we had negative recordings at one point in time. This is when people were talking about the decreasing prices of like a lot of durable goods like washing machines and things like that. They went negative for a little while compared to, a couple of years ago or last year.
Right.
But there's still categories that are, staying relatively robust even amongst the goods segment here. All right. There's non-durable goods, 0.5%. That's kind of more your everyday items that are designed to be used and thrown away. All right. Those are continuing to have like a fairly decent month-over-month increase in prices, 0.5%.
Yeah.
Services.
Oof.
This is the one that Powell said is the hardest to crack. All right. This is where wages really come into play. And compare the goods number at 0.2, services here is 0.3. Right? Services are a little bit smaller as far as the actual categories. And as far as when you look at a line by line basis here, we really haven't had many of these go negative for any substantial period of time because it's hard to put wages back down, right? And that's generally just what happens. We have seen, some things improve. Transportation services did actually have a negative month. Airline tickets is a large portion of that. We finally have had the used car market starting to cool off. So we're getting some kind of, things here that are a little bit more positive for us, negative numbers being positive. But remember, we did a separate video about this. Financial services and insurance, look at that number, 0.8% for the month. This is where inflation is being driven right now.
Yeah, it's absolutely disgusting. Yeah. But I remove my cam because there's just no safe spot on these slides. I'm trying to not cover stuff. But insurance, we did a video where essentially every 12 months you need to reevaluate what you're doing because you're paying an astronomical amount. They're also making record profits, so fuck those guys.
yeah, exactly. Yeah, I know. It's really, really disgusting. I changed my car insurance company. I did not change my homeowners for most recent year. My car insurance company tried to ask for a 35% price increase year over year. And I was like, absolutely not. My homeowners insurance asked for 20%, which was still large, but not quite enough to motivate me because I hadn't been with them quite as long. But next year, I think they're going to have to go. All right. When we look at the actual like overall categories here, all right. So PCE excluding foreign energy, this is that core PCE. This is the one that really represents non-volatile things that people have to spend household money on, and what the month-over-month price changes is looking like here. And when you look at this data, it's hard to really draw much of a pattern out of it, because we've been just kind of perseverating in this low positive category here of between 0.1 being the lowest reading on here to 0.5% being the highest. Yeah, sure, we actually had another 0.5 here in January of 2024. We've come down a little bit over the last couple of months, but we're not really making significant progress on inflation. I want to posit to you now a potential explanation for that. All right.
Okay.
Ignore the names here. Okay. This gets some really politically charged, but I wanted to just demonstrate a little bit about the supply and demand economics when it comes to, government spending. Right. So this is the federal government spending in the United States. All right. And you're looking at two columns here that are really the most important: is receipts and outlays. All right. Outlays is how much they're spending. Receipts is how much they collected in taxes.
Right? Perfect.
And this data goes back quite far. It's so cute to see when the federal government was only spending a few $1 billion a year. These all represent, multiple $1 trillion per year now.
Yes.
So I want to compare the kind of last pre-pandemic year to now, right, to give it a little bit of what has happened to our money supply and demand from government spending. So 2019, last pre-pandemic full year, $4.4 trillion in spending.
Okay.
Right? Now we come to 2024, where we are right here. The estimate for this year is $6.186 trillion in government spending, federal government spending alone.
So essentially, we are at about a $1 trillion deficit for 2019, and then this year about 1.3-ish trillion.
Yeah,
3.5.
These are the deficits here. That's not really what I was going to focus on. This is like then total debt. But what I want to look at is the change in spending rates. Okay, so if I took CPI from December 2019 compared to April 2024. All right, these is actual index readings. It's a 21% increase from where we were in 2019. All right, that's different inflation metric, but that's kind of showing you how much purchasing power we've lost in the last 5 years. The federal government, though, on a yearly basis now is spending has spent 40% increase in their yearly annual expenditure compared to where when inflation was a little bit more tepid.
Okay.
Mm-hmm. Hard to stem back that much spending, right?
It's not easy. This is 100% going to be a political comment section. This is
quite possibly. I wanted to show you this too. We haven't looked at this in a little while, but this is the Federal Reserve balance sheet. Okay, we've almost got back to where we were in June of 2020. As far as their balance sheet, they've been offloading was a $75 billion in like MBS per month. They actually finally turned that down slightly at the most recent meeting. That was something that was kind of like not as well, I guess, broadcast, if you will. But they didn't adjust rates, but they did slow down the offloading of their balance sheet. It was like $50 billion a month.
Yeah.
So the slope of this line is going to start to decrease a little bit. But we're almost back to June of 2020. So you would think that would have had a pretty dramatic effect on the money supply, the amount of money available in the economy, right?
I mean, yes and no, because the amount of money we spent during COVID is astronomical, and it kind of changed things forever. There's not really a going back to pre-COVID possibility when you added 10% of the national debt in 1 year.
Yeah.
It's so much. I think it's more than 10%. I actually think I undercut that.
It's hard to put the genie back in the bottle, but you did actually see a little decrease here in the money supply, but it stopped making any progress as far as decreasing money supply, despite the fact the Federal Reserve, like I said, has been now offloading their balance sheet. In theory, when the Federal Reserve buys something, that money is printed into existence, because they don't have to borrow in order to do it. They just create it to purchase the thing. Right? That's why they're the major driver of inflation. You can, but no one's going to take Dylan bucks for anything.
Damn it.
Well, maybe talk to your wife. We'll see. But the money supply has really not been affected by the federal balance sheet being offloaded there. Right. So this is kind of some news reports from earnings that kind of ties into what I think is going to ultimately be the driver here of this inflationary cycle stopping. So Walmart actually crushed earnings, and they basically were able to say, like, hey, we did so well because we started attracting affluent, higher income households, right? On the same kind of quarterly report, want to slide us up here, you have Target saying that they missed the mark because shoppers are avoiding things they really don't need. I think a consumer recession is coming, and that's what's going to be the major driver of cooling down inflation. And the Federal Reserve is not going to go through a nice staged kind of drawdown in interest rates. They're going to have to respond, stimulate very abruptly. And I think it's going to be a very sharp move in interest rates. Is what I'm
Which
starting
is
to think
what
right
the TLT crew is waiting for. That's
No,
what
right?
we're waiting for, Daddy. All right.
So I don't know if you've seen this chart anywhere, but this is actually delinquency rates. Right? This people 90 days plus delinquent on their loans. Right? And multiple different kinds of credit here, but look at what's happened to the credit card loans here. All right, yeah, quite significant, and that's at a time when interest rates are extremely high, much higher than they were back in 2008, 2009. Right, so people are really feeling that. That's going to continue to go for a while. I'm not really sure. It's a small pool, anyways. The other thing that's really startling here is look at student loans. All right.
Well, that's false though, because everything was put on pause.
Exactly.
So if you're looking at this and you don't know that, you're like, oh man, everyone's paying their loans. No one's paying their loans. It's just you couldn't collect. So that's gonna have a V coming soon.
I mean, I don't even know if you could connect the 2 points. Once you actually start reporting this data again, I feel like it should just start a new graph like up here. Connecting those two is lying to you. The rate is going to be much, much higher than is being reported right now. And the things that we do have data on are, this credit cards more than anything else. You're starting to see an increase there. Same thing with car loans. Car loans, I think you will be certainly influenced by this because you're going to see people that are massively negative equity. There's a lot of jokes about like how there's a shortage right now of repo drivers in order to actually repossess cars. So the number of repossessions being reported and actually executed on are much lower than they should be, just because there's like a lack of availability for actual repossessions. People have a lot of negative equity because people are borrowing 120% plus of the MSRP on these loans and financing that at these ridiculous rates. So it is getting very, very tenuous for the American consumer, and it's going to be consumer sentiment that's going to drive this inflation cooling, and ultimately the Fed kind of moving into more a accommodative financial stance by lowering rates in order to stimulate demand again. I mean, anecdotally, I've certainly started to see it a little bit when I go out for like dinner. Restaurants used to be, everywhere had a 30-minute wait on a Wednesday. Now I'm starting to walk in on a Friday night and get a table immediately. You're starting to see people pull back their spending in many discretionary portions of their budget.
So couple takeaways from this. One, I really wanted to buy Target when I was at 100 and I missed the boat. I do think I'm going to get that option again. It was very interesting to see Walmart and Target have complete opposites on earnings. If you look at their stock charts, it's wild. You would not have thought that was going to happen. Two, is the gray line, is that personal loans, I'm assuming?
I think that's included in it, yes. I think that's one of the categories there. I don't know what portion of it. I bet you if you look at the amount of debt that's in that category, it's going to be infinitesimal compared to mortgages and student loans, though. So it's not going to be a major mover. But I agree. I think it probably is personal loans. Because
I don't see mortgage debt going. I don't see delinquency happen because so many people have homes at a 3% or a 2% interest rate. It's not like 2008, 2009. It's a different situation.
Yeah.
I do think. Do you know when student loans are going to pick back up?
When they start reporting it, I would say it was a 12-month. It's after the election. I want to say is the next time that you'll actually see delinquency data. Yeah. Cool. Tell me that wasn't intentional.
Yeah. No. That's okay. I'm gonna shut my mouth. All right. I'm not gonna say anything. Oh no, wrong button. Sorry.
Like kind of the like one final point I wanted to make about the mortgage situation is, do you remember there was that Burry tweet about how a 3% mortgage and a bunch of dividend paying stocks is great hedge against inflation? He was right.
He has been wrong multiple times, to be fair, but he was right multiple times with this. Now, granted, Chinese stocks have cooled down a lot. Damn it.
Yeah. But now you got that 3% mortgage, and you probably have $200,000 in equity in your home. So the delinquencies on homes are not going to happen.
Yeah, I don't think it's going to happen. I agree. All right, guys. Let us know what you think. And if it's, oh, wait, before I shut this off, when do you think you're going to see the spike of the rapid decrease in rates? And whatever you say, I'm going to hold against you. And you have to make a prediction now without thinking ahead of time.
No, you're definitely putting me on the spot. 100%. I want to say consumer spending really is the fourth quarter of the year. So I think it'll be next January, February, where we'll see how bad consumer spending had fallen off a cliff in the fourth quarter, and that's really going to be like when the decision time makes. So early 2025.
It's going to be October 14th, specifically. I'm just kidding. I don't know. All right, guys. Have a good one.
Thanks.